Welcome back to today's Explainer, where we're diving into a really fascinating paradox surrounding one of the world's most iconic manufacturers, Honda Motor Company. Now, obviously, Honda is a household name, but right now, it presents one of the most intriguing, head-scratching setups in the value investing world. So we have to ask, is it a value trap, or is it a hidden gem hiding in plain sight? Well, that's exactly what we are going to unpack today. Here is our roadmap for today. 1. A first in 70 years. 2. A tale of two businesses. 3. The financial reality check. 4. Weighing risks and rewards. And 5. The value investor's verdict. Let's get right into it. Section 1. A first in 70 years. The billion-dollar contradiction. Let's start with a staggering number, 1.58 trillion yen. That represents a massive EV charge related to Honda canceling its North American electric vehicle programs and completely freezing a major battery project up in Ontario. Now, because of this self-inflicted wound, combined with a pretty heavy hit from U.S. tariffs, Honda actually just reported its first annual loss in nearly 70 years for fiscal year 2026. I mean, on the surface, a first loss in 7 decades sounds like an absolute disaster, right? But here is the paradox. Despite that huge, headline-grabbing loss, the stock is trading at an incredibly cheap 0.47 times its book value. That book value sits at roughly $59 per ADR. So just think about that for a second. You have a legacy automaker that just posted a historic loss, yet the market has priced it at a 53% discount to the actual tangible assets sitting on its books. The real puzzle here is figuring out how a company in an apparent crisis can confidently afford to buy back up to 14% of its own shares. Retiring that much stock when it's trading so far below book value is, of course, highly accretive to per share value. But it really begs the question, if the house is supposedly on fire, why is management acting like they have cash to burn? That brings us to Section 2, a tale of two businesses, the crown jewel versus the problem child. To make sense of this contradiction, you really have to view Honda as two totally different companies bolted together. On one side, you have the motorcycle division, and this is the absolute crown jewel. Honda sells roughly 20 million motorcycles a year. To put that in perspective, that's basically putting the entire population of New York on 2 wheels every single year. They have dominant global scale, a wide economic moat, and they are setting record profits in places like India, Brazil, and Southeast Asia. But then, on the other side, you have the automobile division, the problem child. They sell about 3.4 million cars, but this segment has thin, volatile margins, a shrinking moat thanks to software and EV struggles, and it is highly exposed to those U.S. import tariffs. Now, here's where it gets interesting. If you strip away those one-time, non-cash EV kitchen sink charges from the auto division, something pretty incredible emerges. The underlying operating profit of the business was actually 1,039 billion yen. So, what does that mean for us? It proves the core engine, which is entirely anchored by that phenomenal motorcycle business, is still running incredibly strong. The losses were mostly an accounting reality, not a true reflection of the day-to-day cash generation of the enterprise itself. Let's look closer at that in Section 3, the financial reality check, under the hood of the balance sheet. Okay, it is absolutely vital we talk about the concept of industrial net cash here. See, if you just glance at Honda's consolidated balance sheet, you're going to see about 87 billion US dollars of debt. And yeah, that looks terrifying. But the catch is, most of that debt is sitting in their captive finance arm, and it is perfectly matched by finance receivables, things like car loans. So consolidating the finance arm artificially distorts metrics like the Altman Z-score, which is a standard formula used to predict bankruptcy. It basically makes the company look like a solvency risk when it absolutely isn't one. Once you understand that accounting quirk and isolate just the manufacturing side, you realize this industrial business is an absolute fortress. They're sitting on roughly 3.3 trillion yen, that is about 20 billion US dollars in pure net cash. And even in this big loss year we talked about, the industrial side still threw off 1.58 trillion yen in free cash flow. This fortress balance sheet is exactly why they can afford those massive 14% share buybacks without breaking a sweat. Now look, it's not all sunshine and rainbows. On the green flag side, management is making some highly disciplined choices. They have a really strong shareholder return policy, committing to at least 800 billion yen in returns over 3 years. And they smartly walked away from a potential Nissan merger rather than overpaying for it. But on the red flag side, you still have to deal with that complex accounting, the ongoing structural damage from U.S. tariffs, and honestly, the biggest flag of all, management themselves admitted that even more EV or China-related impairment charges could be coming down the pipeline. Let's quantify that in Section 4, weighing risks and rewards. What could go wrong and what could go right? If we run a weighted SWOT analysis based on our source material, Honda lands at about a 5.6 out of 10. This moderate composite score essentially balances a deeply cheap, cash-rich asset base against some major undeniable strategic missteps in autos. The strength of those dominant motorcycles heavily offsets the weaknesses of their failed EV strategy and the overarching threats of structural U.S. tariffs. Looking at the timeline, this entire thesis really hinges on the idea that the worst of those kitchen sink charges are safely in the rearview mirror. 1 year from now, in fiscal year 2027, their guidance projects a 260 billion yen net profit recovery. Fast forward 5 to 10 years, and the expectation is that Honda evolves into a leaner, hybrid-focused carmaker, one that's still completely dominating the global motorcycle market, but operating with a significantly smaller share base because of all those aggressive buybacks. Which brings us to Section 5, the value investor's verdict. Is it a buy, hold, or sell? All right, let's look at the numbers. At the time of this analysis, with a current price around $27.75, Honda is actually sitting slightly above our base case intrinsic value of $23 to $27. What this means for you is that there is very little margin of safety on normalized earnings right now. Yes, the underlying assets are incredibly cheap, but the actual earnings multiple just doesn't give you a massive discount at current prices. So, if you're a disciplined investor who demands a strict 9% annual return over a 16-year horizon, the math tells a pretty clear story. You need to be patient. Even if we project a fair value of $50 per ADR in the future, which is largely driven by 5% growth from these massive buybacks, you still need to wait for the entry price to drop down into that 21 to 24 US dollar range to safely hit your hurdle rate. I love how this frames the investor psychology. A great mind like Charlie Munger might just toss this straight into the too hard pile. Why? Because the auto segment is going through a massive, highly uncertain restructuring phase, and the accounting is just undeniably complex. However, a classic deep value investor might look at that 53% discount to book value, see $20 billion in net industrial cash, and absolutely salivate at the downside protection it offers. So what is the ultimate takeaway from our source material? The final verdict is a hold. The asset discount provides very real downside protection, and there's no denying that the motorcycle business is a compounding machine. But because of the lingering risk of further EV charges and structural tariff damage, you should really patiently wait for market weakness to build a position around that $21 to $24 mark. That's how you give yourself a true margin of safety. So I'll leave you with this. Is Honda's $20 billion cash pile a genuine safety net, or is it just a comfortable mattress to sleep on while the EV revolution completely passes them by? We will definitely have to watch the market to find out. Look, we love taking this structured, rigorous value framework and applying it to the companies you care about most. So which stock should we analyze next? Leave your pick in the comments below, and we might just dive into it in our next explainer. Thanks for learning with me today.